Hey, it's Jim, and this is Level 3 of the CFA program, the topic on portfolio management and wealth planning, and the reading on risk management for individuals, and this is Part 2. I typically don't read the learning outcome statements at the beginning of the recordings, and I'm not going to do it now, but as you look through the LOSs that we have bolded in red, what I want you to do is recall what I said to you back at the beginning of Part 1. That this reading was written by two individuals who are certified financial planners, which means they are experts on insurance planning. But they also are CFA charter holders, which means that they're going to link the insurance planning knowledge that they have with the policy statement. And that's pretty much what those end of reading questions on insurance planning do in terms of linking to the policy statement. And then what we'll do in Part 3 is we'll cover a comprehensive problem that's about 20 different slides. All right, so let's start with that first one. Notice that at the very end, personal financial planning, there's that certified financial planner link and types of insurance. And so the questions at the end of the reading tend to sound a little bit like, here's a client, here are his or her or their characteristics. What kind of insurance is appropriate for them? And then what kind of tool and how do we manage this throughout the client's life? Remember, the CFA Institute is really big on things like reviewing and monitoring and keeping up to date and communication. And so all that applies to this insurance planning. So let's go ahead and start with uses, types, and elements of life insurance. Of course, this is protection against a breadwinner's premature death. I always find that term kind of interesting. I'm guessing that most people would say that all deaths are premature. So what are we doing? We're just transferring that risk to an insurance company, right? A third party. And so we're saying something like, all right, if we or our clients pass away prematurely, then they get a financial windfall, or at least their beneficiaries get a financial windfall. So look at that third block point. Ideal amount of coverage depends on insurance costs and the dependent's financial needs. I mean, clearly you need to read through the question stem and the vignette, the entire vignette, to get bits and pieces and different nuggets about, what are the characteristics of that particular client and how much insurance do they need? I mean, some people need zero life insurance. Some people need tons and tons of life insurance. And we'll see that as we go through this slide deck. The last point down there, second to last point, is super important. Remember that we don't need to be estate lawyers, but we need to know that life insurance is a terrific vehicle as part of estate planning. What it does is it provides liquidity to the estate. The last thing we want our client to do is pass away and then have the beneficiaries have tons and tons of expenses associated not only with just the burial, but, old-time tax liabilities, other kinds of obligations, et cetera, et cetera. And then finally, there are some tax benefits. All right, two types of life insurance. I'm guessing that you know this. There is term life, which the reading calls temporary, and then there is permanent. And notice at the bottom, this reading assumes that both types are non-cancelable. And so I'm guessing that that's what would show up on the exam. All right, term life insurance. What we can do is say something to the insurance company, hey, you know what? I'd like to have a policy that lasts for 10 years or 15 years or 20 years or 1,000 years. I mean, they probably won't sell it to you for 1,000 years, but those premiums then, they can either be fixed or they can be increasing. Now, the interesting thing about this is that it's called temporary because it's for a fixed period, 10 years. So once that 10 years is up, then you're done. If you don't pass away during those 10 years, well, then you get no death benefit. Now, term premiums are always less than other types of permanent insurance, mostly because the mortality risk for the insurance company is lower. There we have a little barometer there for term insurance. So we're covered during a particular period and we're probably younger, we're probably healthier. I know that I'm nearing the end of one of my individual term policies just because I did 20 years a long, long time ago. So I'm nearing the end of that 20-year period. But, I've lived during those 20 years. I was pretty healthy, pretty active. And when that policy ends, then I'm going to rely on my other policies. But permanent insurance, on the other hand, is oftentimes referred to as whole life insurance. Whole life meaning that there are two components to permanent insurance. There's the term component. Let me go back here. There's the term component, which is a function of mortality. And then there is another component, which is kind of like an investments component. And so this permanent insurance generally provides lifetime coverage for as long as the premiums are paid. So if you're 100 years old and you have no obligations and all of your dependents and you are super wealthy and your spouse has predeceased you, you could probably stop paying them unless you want to keep paying them and donate the proceeds to a charity or give your wealthy children even more capital, right? So there's whole life insurance, and then there is universal life insurance. So let's start with whole life insurance. The insured is covered for their entire life, so fixed annual premium payments. That makes sense. What did I say just a moment ago? That you have to make sure that you continue these payments or the policy can lapse. I used the term some kind of an investment component a few moments ago. That's called the cash value, which can be accessed by the policyholder. We'll see that here in just a few slides. So the whole life policies can be participating or non-participating, and that's where you either share in the profits of the insurer or you don't. So non-participating, those have fixed values. Universal life, just remember the term flexibility in this one. What you can do, let me go back here real quick. Here we go. See right there, fixed payments. So whole life insurance, fixed payments. But here with universal life, what we can do is we can say something like, you know what, I don't have any money this month or this quarter or this year. I'm going to only pay $17. And so you make that $17 payment, and then there are consequences to you adjusting the premium. And that means something like, oh, you know what, if you die over the next 2 weeks, you're not going to get $1 million. You're only going to get $800,000 or something like that. So you can either increase the payments or you can decrease the payments. That's why that term flexibility. And I'm guessing that the Institute would probably use a sentence that sounds an awful lot like, here's Joe as the client. He's looking for flexibility in an insurance contract. Which of the following is most appropriate there? Now, what you can do as this cash value or this investment component is that you can go ahead and say something like, hey, you know what? I want you to invest this in the S&P 500 index. I want you to invest this in 1 month treasury bills. I want you to invest it in artwork from some famous artists over on the other side of the world. You can do all sorts of things. Now, you probably can't get the artwork as part of your investment options, but insurance companies and financial institutions, they're pretty clever. Maybe you guys know the cleverness, is that a word? The cleverness, to try to get individuals to use universal life. Yeah, look at the bottom circle point there. Yeah, policy remains active as long as the premiums or the cash value are sufficient to cover the expenses. And then you can add a couple of different extra things to the insurance policy. These are called riders: accidental death and dismemberment, accelerated death benefit. This is you can take either part of or most of the death benefit if the client is diagnosed with a terminal illness. And this gets a little bit interesting, from a health standpoint and a definition of a terminal illness. I'm sure that you have, family members or friends who have passed away from cancer. Some people, they live with cancer for hundreds of years, not hundreds of years. My father lived with it for 5 months. So he would, of course, been eligible for this. My mother lived with it for 2 years, and there's some people that live with it for 5 years or until they get in remission. So I can't imagine the Institute would test you on this, but there are different definitions of what a terminal illness from a physician means. Guaranteed insurability, and then if you become disabled, you can have a waiver of premium. So let's look at the elements of a life insurance policy. So the benefits, what happens at death. Most people get a lump sum, or you can take it in an annuity. So there's the term of the policy. That's called the duration. Limitations. I'm always uncomfortable talking about this one here. Limitations. The most obvious one is that if someone takes their own life within 1 or 2 or 3 years, then those death benefits won't be paid. Of course, the insurance company, they want to make certain that all of the terms of the contract have been filled until they make those payments, and then they'll need all sorts of identification for the insured. Now, remember, this goes back all the way to what we've talked about with things like confidentiality, and make sure that we maintain privacy for all this kind of stuff. So that relates to all the conversations that we had regarding those professional standards. Who's the policy owner? Who are the beneficiaries? And I'm guilty of this as anyone. One of my life insurance policies goes to just one of my beneficiary, but subsequent ones and my pension goes to all of my beneficiaries. And so I just haven't gotten around to change it. So make sure if you get a question on that you educate the client that says something like, look, you got this policy here and you only have your son, and this policy over here you have your son and daughter and uncle and cousin. Do you want those to link or not? And of course they don't have to. The client can can assign any beneficiary that it wants to. Premium schedule, and then there are the riders that we talked about just a moment ago. So how do we price these contracts? How do we come up with a premium? Mortality expectations. We need some kind of a discount rate because, let's think about it. Me being 61 years old today, if I took out a life insurance policy, let's say it was 20 years, a fixed policy for 20 years, temporary insurance. Well, you got to take the present value of that over 20 years because I may croak tomorrow, right? You need an appropriate discount rate. We've talked about discount rates and required rates of return throughout level 1 and level 2 and level 3. So that discount rate has to be reflective of the risk of the individual passing away. And then, of course, this last circle back there, load, that reflects all of the expenses associated with the insurance company and the contract. Let's see, I talked about mortality expectations a little bit back in part 1. Remember, the insurance company and the actuaries, they pretty much know when we're going to pass away. If we're all, let's just take me, let's suppose there are 1,000 61-year-old college professors who, eat pretty well, eat, exercise, have a history of cancer in the family, right? That has to be part of my historical data, but they don't know exactly when I am going to die. They just know on average that 6 of us are going to die this year and 12 of us are going to die the next year. But what that historical data, future expectations, and those mortality rates, they help the insurance company manage this adverse selection risk. And we've talked about this a number of times. Remember, adverse selection just simply means that somebody knows more than somebody else. And so my initial exposure to this, of course, was when I was, back in graduate school, writing my dissertation, trying to think about academic articles that I could get published. And so we go to the floor of the New York Stock Exchange. There's a bid price and there's an ask price. Well, do the buyers know more than the sellers? Do the sellers know more than the buyers? So if adverse selection risk is higher, then the bid-ask spreads are wider. Same thing holds true here in insurance contracts. Let's suppose that I go to the doctors and the doctor says, you know what, Jim, I'm sorry to say you have 7 weeks to live. So what could I do? I could immediately go to the insurance company and say, you know what, I want this permanent insurance policy. So if they say, oh, sure, Jim, here, sign the contract. If they don't do a health history, if they don't call my doctor, then, what's going to happen? They're going to have to pay those tens of millions of dollars to my beneficiaries. Discount rate, the assumed return on the insurer's investment portfolio. So think about what I said just a couple of minutes ago. Treasury bills, S&P 500, artwork. It's probably some well-diversified portfolio. And so insurance companies, they should have, I ought to say it that way, they should have a pretty good idea of what that required rate of return is. So the net premium is based on those mortality rates and a discount rate, and it must be sufficient to meet all of those future benefits when they fall due. So remember, the insurance company, they know that 6 people are going to die this year, so that net premium has to cover the death benefits for those those 6 individuals, which means that the other, what did I say, 1,000 or the other 994 in the pool, well, those people will continue to make those premiums, right? All right, so the components of the gross premium, then there's the net premium, and then there's the load, and that load reflects all of the operating expenses, the costs involved in issuing the policy, and then some kind of, you can call it an annual net income or profit that's imposed into the model, or you could probably just get away with calling it some kind of an internal rate of return. 2 kinds of life insurance companies. I keep thinking about these kinds of questions on the exam. I'm not sure this is too terribly important, but just remember that stock companies, these are owned by shareholders, so this is just like Milton Hershey Foods and Procter & Gamble. Mutual companies, on the other hand, are owned by the policy holders. And so sometimes if there's lots and lots of profit, that the policy holders then can receive a dividend. And typically the dividend then just goes to reducing the premiums in the future. A couple of additional basic items here before we move on. You can have annual renewable policies for some particular time period, and then every year those premiums will increase. There's that first box, level term policies. This is the one I was talking about earlier about myself. That's what I have. Notice the bottom diamond point is probably something that you know, but it might be interesting for the exam. Mortality rates rise quickly after age 40. Annual renewable term policies are chosen by lots of people because there's lower pricing in the early years, and then they'll say something like, you know what, I'll just get online and I'll shop around as I get older to try to substitute lower premiums as I age, if they can find that. This works okay if we stay in good health, but if we fail in health at some point, then that's going to catch up to us. Of course, insurance companies are aware of the adverse selection costs and risks, and so they're probably prepared for that. All right, let's go ahead and continue our conversation on this cash value. A couple of purposes here. Source of funds for the policyholder, you can take that cash value and you can say something like, you know what, to the insurance company, you know what, send me that cash value. But they're going to throw along some kind of a fees, and they're going to say, you got to worry about this, and you got to worry about that. Maybe there's some tax implications there. So the easiest thing is just to go to a financial institution and say, look, I got $500,000 in a cash value. Will you lend me $400,000? I'll put that cash value up as collateral. So that's a great source of leverage for an individual client. Now look at the purple box over there. In the early years of the policy, the insurance cost is lower, of course, right? Lower because we're younger and we're healthier. But then as we go through the rest of our life and that mortality rate increases, well, then we have kind of a reverse structure there. Insurance companies are required to maintain policy reserves. So these are liabilities. That's probably what the institute would ask you if this would show up. So these policy reserves are exactly like the word reserve means. It's like a buffer or a financial safety net somewhere over there. So just in case, the odd scenario where what did I say earlier? We have 1,000 policyholders. Suppose 942 of them somehow pass away in the next month, then we need to have some policy reserves. Now, if 942 pass away out of the 1,000, doesn't matter how many policy reserves we have over there, we're probably in big trouble. Here's a great exam question, and the LOS asks us simply to describe the basic elements and describe how the insurers price a policy. So, of course, we're going to compare policies between or among several insurance companies, and so what we want to do is we want to figure out, what's the best value for our individual clients. So you can do this under the net payment cost index or the net surrender cost index. Now, here are the calculation steps. Now, I'm going to toggle back and forth here really quickly. You ready? So look, it's 1, 2, 3, 4, 5. I'll go through these here in just a second. And then for the surrender cost, it's 1, 2, 3, 4, 5, and they look like they're the same. Can I toggle back and forth? Can I give you a vertigo here? You see the only difference? The only difference? All right, let's start here. Let's go through this, and then I'll illustrate the difference here. So for net payment cost index, and for both of these, mind you, what we're going to do is we're going to compute the future value of the annuity due for the premium. The annuity due because we have to make that premium today, right? That's the way all insurance contracts work. Then we compute the future value of the ordinary annuity of the projected annual dividend into that cash value, whatever that is. So we're computing two future values. One is for the premium, so that's a cash outflow. One is for the dividend, so that's a cash inflow. It's ordinary because it happens at the end of the period. And then all we're going to do is take the difference between those first two. We're going to then use that as a future value in our regular old 5 time value of money button calculations. And we're going to do this, well, in our example, we have 30 years and 6.5%. And we're going to find that payments, the PMT button on our calculator. And then, of course, we can divide by the thousands to get that face value. So we're going to do the same steps here. So memorize these steps for the net payment cost index. And then for the surrender cost index in step 3, all we're going to do is subtract out the projected cash value. So, of course, the surrender cost index, when we subtract that and use that as a future value, our PMT is going to be less. So, of course, what we want to do is we want to choose the one that has the lower of these indexes, because then that means it has the highest value. Now, the reading takes us through a really, really simple example. And we decided not to do that because all we're doing is describing. So I think it's easy if you just remember, compute future values, take the difference between the two. There's an extra step under surrender cost index, and that's the projected cash value. So I think if you remember projected cash value for the surrender cost index, and of course the surrender cost index is an indication of that projected cash value. I think you'll be able to answer those questions at all. There are 2 light bulbs up there with my explanation for the annuity due and the ordinary annuity. All right, why are we doing all this? Estimating the amount of life insurance. We've talked about why are we doing this, right? Protecting an asset, which is our life. But then, do we need $10 in life insurance? Do we need $10 billion in life insurance? Well, it depends on a couple of factors here, right? Replace the present value of an individual's future earnings. So if we're doing this for myself, being 61 years old, I'm working for another, let's say, 7 or 8 years, take that present value. By then, all of my dependents will be gone. Hopefully, all of them will have really great jobs, and they won't need this money, although they'll say something like, you know what, Dad, why don't you go ahead and get the life insurance, just in case, right? And then, of course, immediate financial expenses. This is great financial planning, insurance planning for us as CFA charter holders. That inside of the policy statement, it's really nice that when you do pass away, that it doesn't cost your beneficiaries or your family members anything. My parents, so this was my mother. I mean, my father, he had no clue about all this. So my mother died about 15 years ago. So before she died, she went up to the cemetery and she bought the land and she bought the faceplates and she did all that. And she even set aside money for our after ceremony celebration of life. And so when both of them passed away, my sister and I didn't really have too many expenses. I mean, and these can be huge amounts too, by the way. And then legacy goals. Those of you who pay attention to my recordings, I've said this many, many times. My father, during his life, even when my sister and I were little, he would say, you know what, when I pass away, I want to leave you this big nest egg. And it was really funny because he was a very humble man. He had a humble profession, and so he didn't have a lot of money. But even in his older years, he kept saying, I want to leave as much as possible, as much as possible. So there was really a bequest function in my father's life. And as I age, I understand it. Although my sister and I don't remember my dad because he left us a lot of money, we remember him because he loved us. All right, how do we figure out what this amount is going to be? So we estimate the funds required to replace that present value, right? So what are we trying to do? We're trying to maintain financial stability for all of the beneficiaries, prevent a decrease in household spending, make sure that the quality of life continues. I'll tell you just a quick story here, and you guys will probably shake your head. I had no idea how to react to this. When I got my very first job, I sat with an insurance agent, and I was how old was I? 30. I was 33 years old, right? And the dude looked at me and said, if you pass away, would you want your wife to have to marry somebody else so that she can maintain her quality of living? And I was like, what are you talking about? Have you met my wife? She's super talented. She's got a great job. She's smarter than I am. Anyway, I didn't go with that insurance company, right? So prevent decrease in household spending, et cetera, there. Yeah, down at the bottom, that bottom teardrop point, we need to just take a moment, talk about the financial strength of the insurance company, right? So you can have high-rated or low-rated insurance companies. All right, moving on to other types of insurance. Disability income insurance. So if you're partially disabled or fully disabled. Property insurance, I'm sure you guys have homeowners and automobile insurance, health and medical insurance, liability insurance. Remember back in part one, I was telling you guys that I used to have an umbrella policy, but then as I aged, it somehow was cheaper to put those same amounts inside of the combination of my homeowners and my auto policy. However that works. Maybe I should know all that stuff, but I don't. Now, one of the things that my father always said to us is, he said, you know what, when I hit that Powerball lottery, you guys, meaning my sister and I, you guys are out of my will, and so he was always very funny about that. Of course, he wasn't serious. But this is what happens, and this is the great example when people hit, for big amounts, then they have a choice to take the lump sum or an annuity. Most people take the lump sum, so they pay a huge tax burden right away, and then they have $100 million. And so, what is the risk? The risk is that they plow through that $100 million in 2 or 3 years. I'm pretty sure that there are lots and lots of bankruptcies for Powerball lottery winners. And so insurance companies know that those people, they are great candidates to buy an annuity, right? So you take that money and you go ahead and buy an annuity, which means that you're going to guarantee income during a fixed period, maybe 10 years, or for the lifetime. And they can be almost any periods. And so the death benefits on a life insurance policy are also good examples. So think of lottery winners and life insurance beneficiaries. What this does is this annuity then helps manage the risk of outliving one's assets. So there's a nice little circle down at the bottom, and so you take your lottery winnings or your life insurance proceeds, you throw it at the insurance company, and then the insurance company will agree to pay you over some time period. So of course these annuities, they can be immediate, they can be deferred. Here are some factors. These are probably good exam questions. The amount of the payment, right? If you hit the lottery for $100 million, your annuity is going to be much greater than if you receive $10,000 from your grandfather when he passes away, right? So the age and the gender and the required rate of return. Now, deferred variable annuities, these are really interesting objects. These are really interesting tools because they look an awful lot like a mutual fund. What you do is you take your lottery winnings, throw it into the insurance company, and you say something like, oh, put this in the S&P 500 index, put it in the 1-month treasury bill, or put it into artwork. So you get to select those investment options. Sometimes these deferred variable annuities, they will include a death benefit. So there's a life insurance component to the variable annuity. Now, deferred variable annuities means that they'll start sometime in the deferred, right? Sometimes in the future, they're going to be variable, right? If you invest in a zero coupon bond and you get no interest during the course of the life, and that company that issued the zero coupon bond defaults, well, then you're not guaranteed a lifetime income. So they have similar risks to mutual funds. But of course, look down at that red diamond point. You can add a rider. You can say something like, you know what, I want you to invest in the S&P 500 index, but suppose that the economy crashes. Can you still pay me a fixed percent? And the insurance company will say, all right, how about if we choose a 0.5% or something like that? Yeah, these deferred fixed annuities, what they're going to do is be just kind of the opposite of deferred variable annuities, so they're going to pay a fixed rate at some future date, right? Cost of buying for younger individuals has to be lower. Who looks for these things? Investors seeking a fixed income in the future with the potential to cash out. So this is very different from that illustration up top. Returns are linked to the market under the variable annuities, and then you can add or subtract the death benefits in there, and they give you some kind of flexibility. You don't have any of those things down there under deferred fixed annuities. Now you can have an immediate variable annuity, and so this is exactly what the name suggests. You can have an immediate fixed annuity, and that makes perfect sense. But then look down at the bottom. You can have an advanced life deferred annuity. This is a combination of a deferred fixed annuity and an immediate fixed annuity. And that sounds like something that we're saying, wait a minute, it's deferred and then it's immediate. And so if you combine those, you get what's called an advanced life deferred fixed annuity. It seems kind of paradoxical, but what happens is that this is just longevity insurance. And so we're gonna say, you know what, wait till I hit age 80 or 85. And what this means is that it's more affordable, right? So if you're not going to get those income until you're 80, then those premiums are probably going to be lower. How about advantages and disadvantages? This is a really good LOS here. Yeah, volatility of benefit amount. So these fixed annuities, they guarantee a fixed income stream. The payouts on variable annuities may go way up or they may go way down. And so some people might prefer the variable annuities, which can potentially increase those payouts, but then others might choose something else. Flexibility, this is always important there. Fixed annuities are irrevocable. Those payouts cannot be altered. The variable annuity, of course, depends on the performance of those underlying assets. And so, when that thing goes up or down, the variable annuity is way more likely to allow the insured to withdraw some of those funds. All right, how about these future market expectations? So with fixed annuities, these things look an awful lot like bonds. So this brings in the specter of interest rate risks. So what does that mean? When interest rates go up, then the value of our asset goes down, just like it does over in the bond market. So when interest rates are going up and you're getting this fixed interest rate, this fixed payment, you're saying, oh my gosh, why did I do that? If I had a variable annuity, then I would be reaping the rewards of these higher interest rates. All right, how about a couple of other advantages and disadvantages? Reduced expected consumption. Yeah, this is the simple fact that we tend to consume less as we age. But because of advances in healthcare, we're probably living longer. So there's kind of like the marginal cost, marginal benefit there. All right, in variable annuities, that market risk is shifted from the retirees to the insurance companies. There's the shift on and the shift off. Payout is based on market performance. And there at the bottom, those arrow points, there's the mortality credit. And there is the risk premium. And so the retirees can benefit from both of them. This probably results then in higher total expected payouts. Let's spend a moment talking about fees. These variable annuities have higher fees than the fixed annuities. And by the way, not sure if I said this a moment ago, I don't think I did, that these contracts, some of these contracts look an awful lot like mutual funds, but their expenses are higher. So what are we doing here? Hedging market risk, administrative expenses, limited price competition. So these variable annuities, they probably lack some kind of price transparency, which makes it more difficult to compare. Fixed annuities, they provide absolutely no protection against inflation. And that's embedded in that interest rate risk conversation that we had just a few moments ago. Variable annuities, they provide some hedge against inflation. Remember, it's not a perfect hedge against inflation. Think of the year 2022 and 2023, inflation in the United States, 9 or 10%, depending on who you believe. Maybe it's as high as 15 or 17%. And then there's some tax issues as well. Annuities are appropriate. You can choose between periodic withdrawals from the investment portfolio or buying the annuity. The choice depends on all of those preferences and factors. What we're going to do next in part 3 is look at a comprehensive example and a review. So this kind of a couple of things that we'll talk about. Risk management implementation. This is what I was saying about the insurance planning component of the entire policy statement. So of course we need to go back to our conversation on human capital, our willingness to take risk and our ability to take risk. We've got to learn how to protect our assets, right? Loss control. So we need to eliminate that or reduce it. So we can avoid the risk, we can prevent it, we can reduce the loss. Here's a good table down at the bottom. This will be the last thing that we talk about here before we move on to part 3. So we have a table 2x2, high frequency, low frequency, high severity, low severity. So what are we going to do? If we have high frequency and high severity, we're just not going to do it, right? If you're worried about dying and someone says, hey, let's jump out of an airplane every week for the next 27 years, sometimes the parachute you'll have, sometimes you don't have it. Think of a James Bond movie or a Die Hard movie where we jump out of an airplane. Does the parachute work or not? If it has high severity and low frequency, like death, regular old death, right? It happens, every so often to us as individuals, then we're going to transfer the risk. That's what we've been talking about here. Low severity but high frequency, we're just going to reduce that risk and we'll retain it for low and low, right? I think I used the example, if we don't want to get wet, we can take an umbrella. So risk transfer, let's look up at that top illustration. So we have the insurance, we have the annuities, and we can have non-insurance risk transfers using long-term leases and derivative contracts, et cetera, et cetera. We can retain the risk by higher insurance deductibles or just lowering the value of our policy. So that takes us through those handful of LOSs that relate specifically to mostly life insurance, but some other kinds of insurance. What we'll do next in part 3 is we'll look at a comprehensive example. So go ahead and shut your brain down. I'm not going to send you to the end of this reading to look at any problems. I'll do that at the end of part 3. So hey, thanks for watching. Good luck studying and have a great day.